Hey, what's going on, folks? This is Mitch back again. In this video, we're going to discuss psychology of money. Did you know that a lot of people, and most of the people, they approach investing and things of that nature just the numbers. Sometimes a lot of people forget that psychology of money there is there, and that's it's tightly involved in there because what? Because why? Because we are human beings and we are tied in the sometimes with emotions, and if we can and control them, that's where we advance and have a better chances with the succeeding in the money question there. So I have my coffee here, so let's get started. One idea, and the first idea, that is emotional intelligence and discipline versus timing the market. Timing the market, it's an idea where you basically trying to resolve it, get it when you can, and all that, the bargaining opportunity, a lot of people buzzing about that, but in reality, it's very hard, almost impossible to predict the market. Why? Because you have to have inner knowledge, and not everybody in the position where all the ins and outs, what good decision gonna be. I mean, we can trace it publicly through media and all that, but in reality there is a very hard to understand hey, what's gonna happen tomorrow, and what could be involved, and things like that, and changes and all that. So it's very hard to predict the market in that sense. So because market, if you will, so if you personalize it and make it like a person, it's very unstable person because everything they changes geopolitically, whatever. So it will definitely address that. Because what? Because why? It's logistics, and where's logistics, everything changes. If the prices of the energy, oil, whatever, delivery rises, prices rise and go that and all that. So that's where we really affected when the logistics stop, for example. That's it all went all the way down. We know that from 2020, 2021, I believe, the recent exposure to that. So but that's basically it. So an emotional discipline is obviously if you keep your cool under stressful situations, like the one that was in 2020 or 2021. So if you want to go in the chart, that's a prime example what happened in 2020 or 2021. And then open up whatever market you're tracing on, Dow Jones, whatever, and see what's happened. So you will see the drop in the price, and then you will see the logistics stop, basically, obviously due to the illness that was going on in the world. So now as an emotional intelligence, and that's in that example, was that you either sell it right just before that, or like I did, I just kept my money in the market and didn't sell. It was very tense situation in the way that I if I sell it, I have to sell it, but I'm glad that I didn't, and I wrote that drop throughout, and that was I'm thankfully, but it was emotional intelligence, I think, and if you will. So if you wrote that through, you obviously you did good. If you didn't roll through, well, too bad. So and that's unfortunate. So but that's the distinction between money and emotional intelligence, where you keep your cool versus you trying to time the market. If you did it, time the market, you sell, and then you bought in the very bottom, sometime in March it was, I believe, and that was very good decision to the where you bought it and sell it and bought it. So but in any case, the difference between is that you got to do that, you got to keep that, and emotional intelligence is way better than timing the market, because timing the market is very unpredictable when you do such a thing. So, and my advice to you is to keep your emotional intelligence in check and push on that. If you're beginning investor and then you starting that, so keep your emotional intelligence in check. Make sure that you know what you're doing, you read the numbers, you do your research. If you invest in the stocks and you go to after big companies and go whatever your strategy is, don't follow all that nitty gritty, fast and furious meme stocks, top stock, TikTok stocks, all that. So follow the numbers, if you will. So do your research, do your check and all that. So And here's the quote from Mr. Buffett. What I like about it is be fearful, and here's the quote: be fearful when others are greedy, and greedy when others are fearful. Why? Because what is the point behind that? You basically buying into that positions like, hey, you know what? Folks are like, hey, going nuts, and you did, and that's prerequisites. You did your research, you know your numbers, you know your company. Let's say like Coca-Cola or whatever. Let's call company, big company 1, 2, 3. You did your numbers, you did your understanding. You read your numbers. You know that the money is in there. Financials are in there, so everything is in there on the paper and everything, so that they submit to the government and IRS and all that. So there you go. So when the market goes kaput or whatever, so that goes down like that in 2020, you know your numbers. So that's basically, if you will, company goes on sale. So there you go. You just went in and bought in. So that's a good example of emotional discipline versus market timing. So idea number 2, and that is long-term thinking versus short-term gains. So as I mentioned, like TikTok memes and all that, so they're promising like big rewards and all that. So right at the short term, yeah, it's good, like when you get it just right, and sometimes like more gain, the idea of more gains and idea of trying to get more and more like prevails, and sometimes you exit in the wrong position. So see, that's already there. So it's already psychology going on. So what I'm saying is that long-term thinking, long-term basis, and that you invest and then raising every year, right? So you invest, you go in after long-term positions, right? So obviously if you want to sell, you're going to sell and all that. So, and then, but the position is that the average investor tries to like sign and go and after like whatever prediction. And one of the good examples was with the GameStop stock. There was a hype because of that, and all of a sudden rose the price, and then all of a sudden just people rode the wave, and then they sold it, and then it just went down all of a sudden, dramatically went down. So for folks that bought in on top, obviously what happened? So they lost money. So, and that was very discouraging for me to see that people followed that fear of losing out, or like TikTok, whatever, the trendy stuff and all that. So it's way out there. So, and I mean, from the perspective of, hey, you know what, I'm an investor, I'm a long-term thinker, so I'm in there, and that's it boils down to speculation, if you will. So you speculate, it goes up, and that's a roulette type of thing, and I'm not promoting that. Like folks do casino and all that, that's their business, they do that's their thing. I'm promoting more stable environment, more stable approach, and then investing with the understanding that what company does and what company is behind it. So if you a businessman, if you like doing, if you operate the business, you will be approaching the business as it's gonna be like living a breathing kind of entity, not in the sense that like, hey, it's actually physically living, but in the sense that like, hey, there's going to be timing involved, there's going to be growth involved, there's going to be things involved that precedes and promotes and getting money. So not everything is done like in the day, in an hour, and the stuff. A very nice famous quote: the Rome wasn't built in 1 day or 3 days or whatever. So it's been built over time. So whichever country, like whichever city you are, that city hasn't been built like in 1 day, right? So it's been built over time. So, and that's the same with business. So expect the timing to go through, because you gotta have like growth involved, because otherwise like you won't make money. So you gotta go, you gotta approach, you gotta call people, you gotta make a deal, and you gotta do all that. So, and earn the money and earn the paycheck, whatever, you do the sale and do the service, do that. So all I'm saying is that time is involved, and when time is involved, the growth will be there, and then as growth there, you will see the company grow. So, and that's basically stocks. But that's what they're reflecting. They're reflecting the growth or downfall of the company. So, and if you're riding that wave with the company, and you know what? Hey, company is growing, I'm growing, so we happy, everybody's happy. If company is going down, like some whatever office even nowhere, so and they don't provide service, don't provide anything, hey, what is gonna grow? Nothing is gonna grow. So, and that's the long-term versus short-term thinking. When you try to go and make a big chunk of money and then like just sell or whatever. So short-term thinking is basically, I'm trying to say, is the fastest way to lose money. So that's what I'm trying to leave you with. So section number 3, and that is behavior versus brilliance, or a higher IQ, if you will. So that aspect, I've been thinking about it and what to push on there. And as the topic of this video, behavior, that's what I'm trying to say, is that behavior is the key perspective and key aspect of stability. And there's perspective of like overtime thinking, strategic thinking, sort of like going after long-term approach versus like one shot and you got it, that's it, there you go, that's you done. But what about tomorrow? What about the after tomorrow? Things gonna have, like, you gotta buy groceries, you gotta do all that. So but it's not like when you do that, so what's gonna do, like it's like you gotta do again. So, and the desire will be there to do it again. So, and that's where a lot of those losing strikes come in. So you did that, you did good, and then next day you're bored and then you want to do it again, and then you lose money more than you made yesterday. So, and that's like one of those key aspects that I want to say, that the behavior keeps stability. Investing is about behavior versus like one-time shot and then you good. So what I'm saying is keep stability and do the research. So, and the brilliance here is that do your research. So that's what I'm trying to say. So power of simplicity, that's number 4 idea. So power of simplicity, what is it talking about? It's what I'm talking about is that investors avoid accomplishment. So what I'm trying to say is that you have to invest, like in not you have to invest, but like simple things that make sense to you. That's what I'm trying to say. Simple things that make sense to you, that make money. People will do those things. They will make money. So I mean, if you're a starting investor, you don't know like a whole lot and all that. So this is very nice, interesting idea. So utility companies, they make, they're gonna be there for like around the block for a few times for sure, because people need like electricity, whatever. So this is a good approach to like do investments and things like that. Plus dividends, stable dividends, payout, growth. This is also a good strategy. That's where I started actually. So because I needed to work on that. So, and I needed to understand that. So, but up to you really. So if you're also like, if you want to switch for growth and things like that, so understand the company again. So make sure you understand the business, the concepts, whatever company is doing. So that's what I'm trying to say, is that if it's too complicated to understand, like what the overall project business model is, so stay away from it. If you do understand it, there you go for it. You understand, like I'm growing potatoes and I'm selling potatoes. It's just simple, but I'm making money selling potatoes, and my sales of potatoes is like growing year over year. So that's simple, but it's good and it's making money. So if company A in the stock market selling potatoes and their sales grow year over year, that's a good strategy to invest in. That's a growth stock, if you will. So but that's basically the idea there. Section number 5, or idea number 5, that is a mindset of ownership, and I discussed that in the last video that we talked about. So not trading. So smart investors think like a business owners. That's a good, because what? Because instead of buying shiny stuff and all the last model whatever, I mean it's good, but overall, like smart people, like smart investors, they approach things like an ownership, in the sense of like stewardship and ownership. That's a given, but They, instead of buying something that they consume, they're buying something that they can produce money for them. So stocks, real estate, things that they generate income for them. They invest in the business, they invest in their own business, if they sell or delivery or whatever. So that's one of those key features, that the distinction between smart investors and not so smart investors. So when you're buying a stock, you're buying a company. Think of it that way. So, and not like a lottery ticket. Well, so obviously there are sections there, like, listen, not every stock is a good stock, so, and the lottery stock, there are lottery stocks, so most of them are very, very high risk. One come to mind right now is like penny stocks, but a lot of folks like them. They do good money for them, but that's their approach, that's their business. So my approach is that I know my company, I know what I'm doing, I know what they're doing, and they're delivering results, they're making sales, they're growing their sales, they have good financials, and all those aspects. When they check out, yes, I'm gonna make my decision, I'm gonna invest my money into that company, specific company, whatever that company might be. But if a company, obviously, there's a good position, but that's, angel investors and things like that, and folks like that, they do their own thing and like do their own business there. And I quite amazed, to be honest, myself, how they do that. But I'm in the position that I'm not really ready for those type of deals. So some people do, and they are ready. So good example, Shark Tank, I think, program, right? So, and that's another advertisement or anything, but that's a good example of getting early in the game, so to speak, as an investor, and then get that good results at the beginning. But if you're investing, like starting beginning the investments, your journey in investment, so try to look for either stocks, if you're in there, like if you're already there. So look for big companies, large companies, safe net, if you will. So, and approach it as an owner, understanding that, like, you bought the stock, you're riding that like wave, you in there, you part of that company, you part of, so to speak, you behind that idea. So then see the growth with that company, so that you got there. So that's basically what I try to implement to you guys. So right, so what do we got? We got long-term thinking, right? So we got brilliance behavior, right? So brilliance versus behavior, power of simplicity. So we talked about simplicity, emotional stability versus market timing, and mindset of an ownership, right? So the truth is, smartest investors are trying to look smart, be smart, and things like that, which, even though like it kind of becomes more as a result afterwards, they playing a different game. What is this? It's a patience, it's a more like a psychology and more persistence and perspective, right? So when you get into that, investment game, understand, like, there will be times where you're like, oh my God, I want to sell it right now so bad. It's crazy. Everybody's decision, everybody's life is different. That's no question there. But if you can keep it there, can you ride it through that emotional storm, if you will? We don't know what's gonna happen tomorrow, obviously, if with the economy and all that, but I'm sure it's gonna be a little bit stable and stabler and things like that, but not the case. So what I'm trying to say is that stay the course, and make sure that you're making decisions not out of your emotional part of you, but from the numbers part of you, like from the cold decision perspective. You know what, this is it. Let's just calm down and see, hey, is this really it, or is this just a crazy notion that's going on? So here's that. So like and subscribe if you like that video, guys. Let me know in the comments below what you guys think about this video, and what, like, if you risk taker or not risk taker. So let me know in the comments below. So I'm actually really interested to understand what you wear, what you deal, and things like that. So hope you guys enjoyed this video. So this is cup of coffee with a wealthy man. So hope you guys enjoy this. So Dmitry is out. So like, subscribe down below. See you guys in the next one. Here's the bottom there. And see you guys next time. Yeah, like, subscribe. See you guys later.